All right, good afternoon, everyone. My name is Aristotle Compass with RealWealth, and I'm one of the investment counselors. Today, we're going to be talking about customized financing options to grow your real estate portfolio. Well, what does that mean, right? Well, we're going to be talking about creative financing. We've been doing a bunch of webinars in the last few months, if you've been attending, on financing, because, I mean, given the circumstances, the interest rates and everything going on in the economy right now is kind of questioning people. Is it still a good time to invest? And if it is, how do I maximize cash flow? How do I make these deals work? Well, today we're going to be talking with one of our newest vendors, RCN Capital, and Andrew Husson is on the call. Andrew's down there. How you doing, Andrew?
I'm doing great. How's everyone doing?
Yeah, good. Thanks for taking the time for us today, or with us today. So Andrew's going to be talking about his company and some of the products that they offer as far as creative financing goes. Now, they are not a Fannie and Freddie lender, which means that they don't have certain guidelines and things like that. So, for anyone who's self-employed and you don't show much on your tax returns, but you show a lot of income, he can work with you on that. Or if you have more than 10 Fannie or Freddie loans, he can work with you on that. They have other products too that we don't specialize in, but like fix and flip loans, all kinds of things like that. So you probably want to pay attention because this is going to be a really cool webinar for everybody, really. Oh, before we get started here, just want to let everyone know there's a chat box or a question box on the right-hand side of the screen there in your webinar. As we're going through the presentation, feel free to write any question you want down while we're going through, and we'll try to get to as many questions as we can. If it's a relevant question, I'll try to have Andrew answer it while we're going along here. So let's read our disclaimer as we always do. So it says that the strategy mentioned in the presentation may not be appropriate for everyone. Other options not mentioned may be more suitable for your specific circumstance. Consult your personal accountant, tax advisor, and/or attorneys to discuss your specific situation. It says past performance is no guarantee of future results. Real estate purchases are subject to investment risks, including the possible loss of amounts invested. While every effort is made to maintain accurate and current information, the possibility of errors and/or updates always exists. Okay, so I'm going to talk real quickly about Andrew with RCN Capital, and I'm going to give you a quick spiel about his company, and we're going to let him dive into it today. So a little bit about RCN Capital. So they've been established in 2010, or they were established in 2010, and they're a direct private lender. Again, they're not a Bank of America or an institutional lender. They are a direct private bank and lender. They focus solely on real estate investors, so they don't work. I don't think they work with primary homes. They work with investors primarily. They specialize in creative and fast lending solutions outside the constraints of federal regulations. So they think outside the box, and they have a common sense approach to underwriting with all approvals made in-house. So they do a lot of really great stuff here, and they've been around for a while, so they definitely know what they're talking about. So again, Andrew, thanks for joining us today. I appreciate your time.
Yeah, thanks, Aristotle. Let me just get us kicked off here. Just so you guys know a little bit of background on me. My areas of focus were really in real estate. Most of the things I did before I came to RCN were related to literally actually doing modeling on the real estate investment market. One of my areas was research was even the effects of metro stations and bike share stations in Fairfax County, Virginia, and how that's affected home prices there over the past 10 years. I started with RCN about 2 years ago. Been a loan officer here ever since then, and helped close hundreds of loans since I've gone. So business is looking good, and I'm excited to get connected with you guys and help you out with your real estate investments going forward.
I appreciate it.
So just a little bit of background here of why RCN has grown so much and why this private lending space and kind of your non-traditional financing has grown so much in the past few years. Really, we've seen a huge boom in the amount of real estate investors actually buying homes versus actual home loans. This goes back to Q3 of 2021, but this trajectory actually has continued to increase and has actually gone up even more into 2022. We're not seeing massive slowdowns in this market at all, and we project growth throughout this year. So we're not really seeing any concern on our types of loans and the product we offer in terms of the rising increased interest rates, and we can go into some discussions later about what we're doing to combat those and what we can do to help build programs that work best for you in this climate. And this is just to speak more to the fact of really about these 30-year loans, what we call these DSCR loans or rental loans. These have seen a massive boom over the past 2 years. That brought on by the increased appreciation of home value, really, causing a lot of home buyers to be outpriced out of buying a home, but people still got to live somewhere. So renters have gone up massively, and we've seen huge increases in rent and project to see that throughout Q2, Q3, and Q4 of this year and into the next, as we continue to see a shortage of houses in the U.S. market, and as we continue to see appreciation of houses, and also now with this rising increases, rises in interest rates, we're definitely going to see this continued push for rent values going up, which can, on the investment side, really help us with that cash flow, as that directly combats those increased rates on these loans. The biggest areas of focus we've really seen this are your single family to 1 to 4 units, but 5+ units as well, which is another product that we also offer, has also been an area of growth and one that we see into this year.
That's amazing that 36% of households are rentals. I mean, that's gone up tremendously in the last couple of years.
Yeah, absolutely. It's absolutely insane. I know, like the traditional model that everyone kind of thinks of, and there was definitely a larger amount of volume in kind of your QM and traditional market over the past 2 years, has been those ridiculously low interest rates. I mean, I helped my mother. She was refinancing her condo and got it at like 2.5% on a 15-year, which, when you think about it over the course of 10 years, you're just like, how is that sustainable? But really, over that time, rental numbers have gone up a lot too, as people started to realize, especially when those rates were low, they could tap into this market. They could acquire these real estate investments, both through the appreciation, gaining value there, but also just through the massive increases in rent, which has made this so much more sustainable and kind of long-term sustainable as well, with that kind of shortage of housing factor being priced in there. And then this is just the fact, like we project this, and many top economic experts expect this to increase, driven by those factors we touched on. There's not really many factors that would express that rents are not going to, at the very least, stay where they are or increase throughout the year, because the demand for it is rising. All these kind of factors that contribute to rising rents are on the rise, i.e. higher interest rates. It's harder for people to buy a direct home loan right now. Well, they still got to go somewhere. So they're going to look to renters, and that's going to drive up your demand for that, which is going to, if you own these properties, allow you to charge more for the same valued asset that you were before. Additionally, with home shortage and rising populations, you're still going to see that it's going to be harder for people to buy homes, not only because it's more expensive, but because there's less of them. And so owning that real estate investment not only becomes valuable from the rental income, but as that shortage continues to go, we still project appreciation in those markets as well. So holding these assets simply as less of a cash flow, but more of an appreciation value, which you can see in a couple different markets, can also be another way to kind of look at your return on investment on these properties. This is where RCN has really come in. That's where our source came from, and it's what we kind of specialize in now. So we strictly do real estate investment commercial loans. What do we mean by that? We always lend to a business entity. So we don't make loans out to individuals. We'll make loans out to typically an LLC. That's supposed to protect us and you as investors. By putting things in an LLC, you're putting yourself at less risk. And it helps us as a company because it allows us to write loans for you that we can do quickly, without limit, so you can increase your scalability. As we're talking to you about that 10 kind of Fannie Freddie loans, we don't have that limit. We have investors who close 100 loans with us a year. It's not an issue with us. One of the real big advantages of this type of product as well is our loans are not reported on your personal credit. So you do not have a backstop to how many of these you can take out, and you can really scale and build your portfolio with our product.
Andrew, I've got a question here. Since your loans require an LLC to get, does that mean that if for some reason the borrower defaults, does that mean that the LLC is responsible for paying that back, and not the individual?
That's a great question. So how we do our loans is we'll make the borrower on the loan is going to be the LLC. What we do is anyone who's a 20% member or more on the LLC signs on as a guarantor on the loan. So they are recourse loans. Typically speaking, the main thing up for collateral is going to be the subject asset itself. And that's usually the only thing that really gets involved there. The reason that we do leverages in the way we do is kind of to protect that. But technically speaking, if someone were to default in the loan, the asset where there is a guarantee in that loan, and that is a personal guarantee. So these are not non-recourse loans; these are recourse loans.
Perfect. Thanks.
Yep. Any other questions on kind of the type of loans or on that while we're just kind of on that topic?
Not really. We have some other questions that are non-pertaining to that. We can answer them later, but yeah, we can move along here.
All right. Oh yeah, this is just to go over the different types of programs we have. So as Aristotle kind of hit on before, we really do everything real estate investment. The majority of our business is the kind of your 30-year long-term rental products, whether it be cash out refinancing or straight rental purchase of these products. However, we offer everything across this spectrum. So we do 5+ units, both on a short-term and long-term basis. We can do fix and flip or fix and hold loans. Fix and hold has been a very common strategy throughout these years through that BRRRR strategy of buying, rehabbing, refining, and renting. And we have a lot of clients who will buy their properties and come to us after that for that long-term rental refi. This is just to say that if you've got a real estate investment property, you can always feel free to reach out to us because we'll probably have a product available for you. We are also, again, a direct nationwide lender. So when I say nationwide, I mean almost the entire continental U.S. We can go all across the state. We also lend in Hawaii for short-term loans. We don't do the long-term loans on those. But other than that, there's only really 4 to 5 really continental U.S. states to think about that we cannot lend in. And there's only really big one of note in there, and that's Nevada. We did used to lend in Nevada, and in the future, we actually may open that up again. Nevada is what you kind of call a non-lender friendly state. One of the reasons we don't have it there is you have to have a brick and mortar office in the state of Nevada in order to lend there, and we no longer have that. We used to about 2 years ago. But other than that, it's Minnesota, North Dakota, South Dakota. I think I've gotten one inquiry about those states over my course of time here. Typically doesn't come up, and then the only other one of note there is Vermont. So anywhere across the country, I do business with clients in California, in Maine, in Pennsylvania, in Florida. These products work everywhere, and we do not restrict them to different markets.
Yeah, and we're not in any of those blue states. We're mostly in the Midwest and the South, so we're pretty much good to go on that.
Yeah, I would say the bulk of what we do, and most of our clients are coming from, are kind of your Rust Belt, Sun Belt, Bible Belt sort of area, and obviously Texas, huge market as well. This is just to hit on the points again. Really what we can offer you is compared to kind of your QM loans is the scalability and a process that you can count on. Really big advantages that we can offer them are, one, the fact that I am actually not going to be looking at income or tax returns to do our loans. Our loans are based on the real estate investment asset and liquidity. What do we mean by that? When we're doing these rental loans, if the project cash flows itself, that is the income factor of it. We have a minimum cash flow that needs to be hit on it to make sure that we're doing a safe investment for you and that the loan, we're not over leveraging. We then only require that the borrowers show about 9 months of payments on that loan, plus about 2% the size of the loan, and that there is no cap on the number of loans you can take out doing that. So as long as you have that liquidity available for that product, or if you're doing a cash out, as long as that cash out shows a certain amount of excess liquidity of what we would have required on that, you're not going to be held back on the number of loans you can take out, assuming that all those deals actually make sense. So we are looking at all of these on an individual basis. We really want to make sure that that asset cash flow makes sense. But if that's there and you've got the liquidity requirement, there's nothing going to be holding you back with us. And it's going to be a kind of a continual process each time that gets easier and easier the more you work with us and establish a relationship with us as a lender. We also, yeah.
Oh, sorry to interrupt you. Emily had a question here. She said, what's the minimum cash flow requirement? You're talking about cash flow that's required?
Great question. So for your 1 to 4 family homes, we have a minimum cash flow or DSCR, debt service coverage ratio requirement of 1.1. How we calculate that is we'll take your monthly rent and we're going to compare it to PITIA payments. So for 1 to 4s, we're only going to look at annual insurance, annual taxes, and then the principal and interest on that loan, and any HOA fees if those would apply. As long as that ratio is 1.1 or higher, you're going to be able to go up to the max leverage. We can also reduce leverage if there's constraints there, or talk about different program optionalities to help with cash flow in the right type of circumstances. And we can hit on that a little bit more later in the presentation.
All right, perfect.
The other advantages that we really have is we are a much more direct communication line and very focused on customer service. Once you get signed up with RCN, you get assigned a loan officer there, and that is your contact at the company for the rest of your time working there. So from beginning of intake to the time that loan closes, that loan officer is going to be there with you to walk you through every stage of the process. We do everything in-house so that we know our whole program, and you're not getting thrown around to different clients. We want you to have a relationship with us, and we want to be able to discuss your investments with you from beginning to end and let you know that the person who told you there is going to be there for you at the end, whether it be into servicing or later. This is just a brief overview of our kind of 1 to 4 family rental loans, these 30-year DSCR loans. We can go up to 80% loan to value on these loans. That would apply to both purchases, cash out refinances, and rate term refinances. The caveat to that is for that 80% loan to value on your cash out refinances, that does require a 760 plus credit and the loan not be over 500,000. If that is the case, then we can go up to 75%. These loans typically go between around $50,000 to $2 million. The bulk of our loans in this area are typically between $200,000 and $600,000, but we do have flex to go in kind of those other directions there. Again, we're only lending on investments, so you can't do anything owner occupied, and that really does apply to any of the units. So let's say you were buying a 3-unit. We couldn't do an investment for you if you're going to stay in 1 unit and then rent out the other 2. It has to be a purely investment property. The really big advantage we have on this product is our optionality with it. There's a lot of lenders out there who have been kind of following cookie cutter models when rates were low, and that was the kind of the way to go. We have always had these options to it, and that gives you as an investor an advantage here. We have the all your ARM options, 5-1, 7-1, 10-1, and the fixed rate option. We have different prepays. I can even go down to as little as a no prepay on a 30-year loan, depending on the situation. Typically speaking, though, I can change it 3 years, 4 years, 5 years, different interest-only options. With all these options, that point of having a direct point of contact becomes very important because while we have all the options, they aren't necessarily the best option in each case. And what we do with you is have a conversation to make sure we're setting you up for a program that makes sense for that investment. And we can talk you through and show all the numbers every single time you have a potential deal that you're looking to get into.
If I can stop you real quickly, so the long-term rental, yeah, just for everyone who's on the call probably has questions about this, or they're in the same situation. So the typical client that we have would be someone who, again, self-employed, doesn't show a lot of income, and they can't get a typical Fannie Freddie loan from one of our other lenders that we work with. So they go to you, and you can offer a 20 or 30-year fixed rate on a single-family home. Just want to make sure, right? Yeah. So
we actually only have a 30-year product at the moment, but all these other options apply to them.
Okay. Yeah. So good. So for everyone listening, he can do 30-year fixed. What's the, I know it depends on everything, but what's the average interest rate like on a 30-year fixed loan if someone were to do this type of product?
Yeah. So I can say on average right now, I would say usually somewhere around 6.5 to 6.75% on the loans right now. However, it's really varying. I always like to have conversations where I'm upfront with my clients. I don't know exactly what the space is going to be in 4 months. And I want my clients and everyone to understand that. But what we can do is build an investment plan for the short term and also for the long term of saying what works right now. How can we make this so we have the optionality for later? One of the examples I'm going to show you guys later kind of hits on that point perfectly of we can get you these investments now, but maybe there needs to be something built into the loan to be able to refinance out of it later at very, very low cost. And this is something we can hit on so that you can continue to make these investments now and still have them make sense, but you also give yourself that optionality of not locking yourself into a long prepay 30-year fixed loan if rates are high. Maybe you want to refinance earlier. We can build you a program that does that.
Okay, perfect. And then do they have the option to buy the rate down on these loans?
Yes. So how our loans work, and in a couple slides I'll point this out. We actually, on our 30-year product, we don't charge any base points on the loan. Our fees are extremely low. It's a base fee of $1,214, and then there is a par rate, essentially at no points on the loan, and then you're given the option of basically picking your points to make sure, like, what cash flow do I need to hit? What rate do I want to see on that? That is going to be fully up to you, and there are buy down options for that.
Perfect. Okay, great.
All right. This is just to go over kind of the 5+ product. It's pretty similar to the 1 to 4, slightly higher loan amounts. You'll see that kind of equivalently goes across what the loan amounts were otherwise. If it was $50K for a 1 unit, then it's going to be $250 for a 5. The big difference on this program versus the 1 to 4s is you're seeing about a 5% leverage reduction across the board. So for those purchases and rate term refinances, we can go up to 75%. And then for your cash outs, we can go up to 70%. Everything else across the board is pretty consistent for that program comparative to the 1 to 4.
Here's a question, Andrew, that I was just thinking about. You mentioned earlier that the properties have to cash flow, right? So a lot of the properties that our clients are going to be buying through our company, through our property teams on the ground, they are not rented. Like, let's say they need 60 days to get renovated, or it could even be new construction. Does it have to be leased? Does the home have to be leased before you can close on it? Because typically that's how these loans work, or how would that work?
That's a great question. We do not, especially for purchases, we do not require a lease fee in place when we're closing these loans. Typically what we do for those is we will put in a 90-day post-close condition that a lease be put in place for at least 90% of what the market rent comes back on an appraisal or other valuation option we get. So we write these loans on, okay, let's say the market rent were $2,000. If it's unleased, we're gonna underwrite that as if it's cash flowing at about $1,900 and say, okay, this is fine, just provide us a lease, and within 90 days of closing, for that amount, and then we're fine. Obviously, it presents a little bit of an easier process if it is already leased, but it's not something that's going to hold you back. The only time that it may be a concern, and again, there is always management approval on these sort of things, and we're willing to be flexible, is when we're doing a cash out refinance. Typically speaking, we're going to want to see at least 50% of the units be leased. For single families, we do not require it, but let's say you came in with a 2 unit and you wanted to do a cash out refinance, we're going to want to see at least one of those units be leased at the time of closing.
Okay, perfect. Thanks for explaining that.
Yeah, the big restriction on leasing is actually with the 5+. That has a much higher restriction on occupancy rate because of the style of these properties. Typically speaking, you're going to want to see an 80 to 90% occupancy rate on your 5+ units. These are a little bit of a different animal to your 1 to 4s, and most of these are sold stabilized anyways. So this really is rarely an issue that comes up, but something of note that's a little bit different to your 1 to 4s.
Okay, and here's a couple of people that asked, since we're talking about this, since vacation rentals, we do offer vacation rentals in a couple of our markets. How do you deal with that? As far
Great
as
question, and that's actually one of the really common ways right now that people are combating this increased rate. We do offer a short-term rental product for your 1 to 4s. We don't offer it for 5+, but functionally, it is the exact same program as that 80%. The only difference is for cash outs, I can't go up to 80. I can only go up to 75. But all the rest of these options are all available for your short-term rentals, whether it be Vrbo, Airbnb, the such. What we really do for those in how we calculate cash flow, the ideal situation we're going to look to see is if someone has, let's say, about 12 months of operating history on that short-term rental, we're going to take the average monthly rental income, and then we're going to take 80% of that. And that's what we're going to say the cash flow is. You are not constrained by what the long-term market rent is there. We do not require a lease be in place. It is functionally the same program. If something does not have short-term rental history, we can work with our team to use kind of AirDNA and other data like that. But obviously, you're not going to have as much kind of say-so in what the cash flow on that property is. And we're kind of going to have to go off of what the quote-unquote safe market value may be, which may be a little bit more conservative than what one could actually rent it for. But considering the risk associated with these, it's something that we have to do to make sure that we can continue to offer these loans.
Oh, perfect. That's awesome. Great. Good to know.
Right. Now, I really wanted to go through kind of just a specific example and kind of the two main things that we're doing when we're building loans. The biggest thing and most important thing alone that we look at is what is the investment plan? That is going to structure how we build the loan for you. What we are most concerned with, as I hit on before, was the asset itself and the business plan you're doing, because you're kind of doing a business loan with us. We want to make sure it's like, where do you see yourself in 2 years, 3 years, 4 years with this type of product? Because it's really important that we know that so that we can offer you the best service possible. Sure, we could write you a cookie cutter loan, but that might not be the best thing for you. And the only way we can know that is if we know, hey, what is your plan to do with this? How much optionality do you need? What cash flow number do you need to hit? When do you think you're going to refinance this property? These are all really important questions that you can talk to directly with a loan officer here who can help you design a program that's going to fit your needs. Really, when we look at these, there's two main things we're going to look at in terms of strategies. Now, there's obviously a little bit in between on these, but it's really when you're acquiring these assets, it's really a question of, is the asset really more for appreciation and we're just kind of owning it so that our renters can pay for our mortgage and give us a little bit of cash flow while we hold on to this appreciating property to, let's say, retap into in 5-10 years? Or is this purely a cash flow property that it's kind of a set it and forget it sort of situation? I'm going to get it on cash flow, and I just want to keep building a portfolio of those. Those are kind of your two ends of the spectrum and are going to shape how we design these programs.
Yeah, and I'm glad you bring that up, because the thing that I've been talking a lot lately with is, new construction homes have never really cash flowed that great for most people. So one strategy that I've been talking to people about is, hey, look, if you're interested in buying a new home and most new homes are usually in pretty good areas or decent areas, and they're probably going to have more appreciation than, something in the lower price point. One way to go is to get an ARM, and you'll talk about that here in a minute, but talk about an adjustable rate mortgage, because if you offer a 5 or 10 year adjustable rate mortgage on a new construction home, that's going to provide you more cash flow, more of a cushion in case something goes wrong in the next couple of years for maintenance, rather than just going with a traditional 30-year fixed loan. So an ARM is going to be great for maybe the people who maybe plan on selling the property in 5 or 10 years, because most people either sell or refinance their home around 10 years or even before that. And then the cash flow product, like you said, that would be, you can use an ARM for that, but if it's a long-term 15, 20-year hold, you probably don't want an ARM.
Absolutely. Honestly, when I look at all different types of products, I use and write loans for all of our different products. So I often see these new construction homes come across, and honestly, most of the time I see them in 90% of the circumstances, there are about two ways that we typically would advise on that. One, short-term rental can be huge if you're in the right market for that. That is a great way to boost the income on those properties. They are brand new. They look nice. They're in nice areas. It's an easy thing to market as a short-term rental. Very common thing, especially in Houston, Dallas area now, has been these kind of month-long rentals as people have been working more from home. They are taking these vacations into different areas, and these new construction homes can be a great source of income. Something that would have cash flowed $2,000 a month can cash flow $6,000-8,000 a month. And now you're not so concerned about the rate anymore. Sure, we'd all love it lower, but as long as that property is bringing in the investment out we want to see, that's what really matters. And really the second thing is the appreciation. Typically in these areas, you're going to see the value of these homes go up. All right. So I'm going to go over an example with you of a loan that basically I wrote last month. So this was actually it was the beginning of this month. So this was a very cookie cutter scenario. This was a 4-unit home valued at $230,000 in Columbus, Georgia. Not a massive market, but this is the type of loan that I will do all across the country. So we did an 80% loan in this case, as we talked about before. So that's a $256,000 loan. This borrower had just above a 700 credit score, so pretty good. But obviously, your rates are going to go down as that goes higher. All these factors kind of affect our pricing on loans. We got market rents of about $800 a unit on it, so it was cash flowing pretty well, as you'll see kind of from the DSCR factor here. And the first time he came to us, he was just like, okay, I've done this loan before. Can I get a 30-year fixed, 5-year principal and interest loan? And so we priced that out for him. And you'll see here, as we kind of talked about before, you're kind of seeing in your mid sixes, upper sixes at the point structure, but we have this par pricing option all the way down up there. And we'll show you, okay, what is your TIA payment at all these options? What's your cash flow number looking like? What's the rate? So we can discuss, okay, what do you need to hit? Where are you at? And how can we help get there? We are never going to restrict you on any of these options. These are fully up to what is best for you at the time. Are you more looking to acquire an asset and get as much capital back or retain as much capital as possible to build? Maybe the 0 point option is the best way to go. Is this a one-off purchase? You're just looking to get the lowest rate on at the time? The buy down option might be more advantageous. And there's obviously anywhere in between there for whatever situation fits you the best. Now, this is kind of the cookie cutter situation we were probably dealing with a lot more last year and the beginning of this year. What did we actually end up going out for this borrower? Well, for this borrower, we actually ended up almost going in the opposite direction, and what this other slide is going to kind of speak into. So I talked with him a little bit. It turns out he was like, oh, you know, I actually think I'm probably going to refi this loan in about 3 to 4 years because I think this area is going to be on the up and up and it's going to appreciate. I also think I can get a lower rate later. And it's like, okay, well, is there a reason that we need the 5-year prepay then? Because, you know, you're going to eat some costs when you refi it later. And we can avoid those costs at a slightly higher rate now that in the long run is actually going to save you some money. So we got him down to a 3-year prepay because that's what he imagined he was going to do with this property. He was more about just acquiring the asset. It cash flows pretty well now. I only needed to hit a certain number, and I really think this is going to appreciate. And I think I can refi it in 3 years' time when rates will likely be lower, and I won't have to eat a cost in order to do that. We put him on a 5-1 ARM because he's like, I'm not going to hold this note for longer than 5 years. If you're not going to hold it for more than 5 years, you're paying a premium to have a fixed rate mortgage. Now, that does not always mean that the ARM is the end-all be-all answer to everything. It only makes sense if the business plan aligns with it. If someone tells me I think I might refi in 5 years, 5-1 ARM's a little bit risky because you're putting yourself up for that potential risk there. You might win, but you might not. You're kind of rolling the dice. Maybe we put them on a 7-1 then because they're like, okay, around 5 or 6 years I do that. Or I'm going to hold it for 8 years. 10-1 ARM is likely your best option. Again, the business plan driving how we build these loans for you. Additionally, one of the biggest ways that we see to combat cash flow issues is an interest-only option. Now, this can only make sense in certain situations, but a lot of the time, especially on these purchases, we see that, properties being under-rented. That is where an interest-only option makes a lot of sense because all the lender is going to see at that time is, well, this is the cash flow you're getting. But if we know, oh, we project this market to increase 30% over the next 2 years on cash flow, a 5-year interest only makes a lot of sense because it lets you cash flow better now. You're not seeing a massive increase in rate. Typically, the difference between a 5-year fixed rate mortgage, principal and interest, and a 5-year fixed rate mortgage, 5-year IO is about 0.2%, 0.15% of the rate. So you're not eating a massive cost, but that can save you a lot of short-term money now or allow you to go with these lower buy down options and save you that capital on the front end if it makes sense. But yeah, and for this borrower, we actually ended up going with a 3-year prepay, 5-1 ARM, and then the principal and interest, which saved him a little bit of rate. So his rate ended up being about 0.1% different, but he has a 2-year less prepay, and it's not really costing him any much different. But now he's in this situation where, hey, in 4 years, I'm not going to have, or in even 3 years, I'm not going to have to eat any costs when I know I'm going to refi this loan. And that, well, it doesn't save him a huge amount of money now. That could save him thousands of dollars in the future, and why it's really important that we always have these conversations with our clients.
Yeah, this is great. This is just, it illustrates the point that, yeah, interest rate is fantastic. And like you said, everyone wants a low interest rate. But at the end of the day, if you're getting close to what your cash flow or your return is going to be, who cares if it's a 6.5 or a 7? I mean, yeah, everyone wants the lowest interest rate, but at the bottom, the end of the day, if you're getting close to what you're wanting, then I think that's all that matters, in my opinion.
Absolutely, and that's what a lot of my clients that we've been talking with them is like, these are DSCR loans. These aren't rate loans. We'd all love to be offering the lowest rate possible. I would love to offer clients a lower rate on it, but we have to move with the market. And one of the biggest things I advise, like essentially my seasoned clients on, they haven't really been hit with ticket shock. About 2.5 years ago, this was the state of our market, and they've been doing these loans all throughout then. It hasn't slowed them down at all. And really the big thing with it is because of that scalability and the flexibility in the program. If you can find an asset that makes sense, we can build a program for that asset. You can close in 3 to 4 weeks very quickly in a smooth and painless process. And then you can keep doing it over and over again at relatively low cost, or whatever cost you would like if you think you found that golden egg and you want to get it on the lowest rate possible. And really, again, focusing on that cash flow. These are investments, so really making sure we take as much of a back approach to it. Look at this asset and say, you know what? Sometimes that might mean I look at it and say, you know what? This just isn't really cash flowing that well. I can get it to our bare minimum, but is that the best thing? And that's what I can always say. We will always work with our clients to do. We're not trying to push them write the loan. We're trying to make sure they're writing the right type of loan, and that we are giving them an investment strategy that makes sense. And again, also with this was on just, this is another point to hit into. These 4-unit properties, as we see here, even this was actually relatively a high one in what I usually see, can be another great way to increase rent. Single family homes are one of the best homes for appreciation value across markets, but actually they cash flow a little bit less than your other types of units, simply because you can get more value per square footage for your 2 to 4s. You could have equivalent homes that you can actually buy. You could have completely the same. You have a 2,000 square foot 4-bed, 2-bath single family home. You could compare that with a duplex, which is 1,000 each, 2-bed, 1-bath. You're probably going to cash flow $400 or $500 more a month on that duplex. Obviously, you're going to eat the costs of increased management, those things like that. But oftentimes you can make up for it, and especially as we see these rent numbers go up, that's only going to be exacerbated as we go forward. Again, though, they also don't offer that appreciation strategy as much as they have historically and continue to be kind of less as is value and appreciation per square foot as compared to your single family homes. Yeah, above all things, as we always say, RCN is always going to be looking to build loans that make sense on your business plan. The most important thing we look at in your loans is the subject asset itself. If that doesn't cash flow right, doesn't really make sense, then we're really going to hit a stumbling block. But if that makes sense, we're probably going to be able to build something for you. How we kind of determine our loans, as we said before, is leases, whether existing or not existing, to determine cash flow, how much your cash reserve requirement is, not your income, how much market saturation you have there. So obviously we're going to look into, hey, somebody just bought 50 homes in the same street in a year, which we've had a client do that before, and it did work out. But sometimes we want to make sure that not only we are being careful, but we're also advising our clients on that, because it can put you at more of a risk. And then, as always, we also look into the background, experience, credit of our clients, as that can factor loans. Someone who's done this 5 or 10 times before is going to get a good amount more leniency than their first time doing it, even though we have a product for all of those types of clients. This is just to let you know, I am always available for you guys. This is my direct line number. That's where you can email me. If you ever email me, I will email you back pretty darn quickly. And you're going to actually see a schedule meeting link for me. Mine is set up that you only have to give me a 15-minute notice, and you will see my full calendar for today, the next day, into a month. So I'm always looking to connect with you, and you do not have to worry about ever thinking that you're wasting my time. I will always love to talk with investors, talk about a business plan. I'm really looking to build relationships with you guys for the long term.
Yeah, you can also find Andrew's information on our website at realwealth.com, and you log in and you go into resources, you'll find his information there as well. So I don't know if we have a link to his calendar on there, but like he said, you can email him and you'll get a link back, and you can set up a call with him to talk about what questions you have. But we're definitely, I think the next slide, Andrew, I think we're gonna go over some questions here that people might have. I think that's the next slide here, right? Yeah, questions. So let's go through some of these questions. So for everyone who's still on the call here, we got quite a few people on the call. So Tommy asked here, can you lend to a brand new LLC with no credit or purchase history?
That is correct. Yep. So what we pull background and credit on the actual guarantors or the individuals on the loan. I don't need to have an LLC's bank statement. I don't need to have an LLC's, like, it doesn't have to have a credit history or anything to it. That is simply the borrowing entity on the loan. You can use assets from any individual on that LLC, the LLC itself, or any other LLCs that the borrowers are involved with. All we will do is collect the operating agreement for those to confirm that you have authority over those funds.
Perfect. All right. All right, Brian. Brian was asking here. He said, "Can an investor do a cash out refinance without showing a lot of income for the past 2 years?" So basically, he was
Yep.
saying he was self-employed for 2 years and he's been trying to get his business up and running. So you guys can do that.
Absolutely. That's one of the biggest ways a lot of our investors kind of start to build up a portfolio. A couple of them come to us, they own, let's say, 2 or 3 rentals, and they're worth about 200, 300,000. They'll do cash out refis on them as long as the borrower has enough liquidity for that. And there's a good amount of flexibility with cash out refis, especially if they're owned free and clear. As really, that's kind of the liquidity in itself. But as long as those properties themselves are cash flowing, we're not looking, I do not collect in our underwriting process a tax return and income statement. I only collect 1 to 2 months of bank statements, and that is it.
Yeah, that's awesome. Yeah, because there's a lot of people out there that might qualify, but they just don't want to go through all the red tape. Obviously, you're going to pay a little bit more in closing costs and interest rate, but for some people, it's worth it because they don't want to go through the hassle of all that stuff. But
Mhm.
so yeah, Jim and Bessie ask, will the presentation be available for review? Yes. So we are recording this presentation. So if you guys want to go back and watch this, it usually will be posted on our site within 2 or 3 days. So maybe this weekend, and so you'll get an email notification that we have that. But yeah, that will be located under Andrew's contact information. When you log in and go to his information, you'll see a education tab, and you'll see this webinar there. So stay tuned for that. Okay, we just talked about Airbnb, so you do that. How you handle the income is pretty much the same as a regular property. Do you offer any non-recourse loans if purchasing through a 401k? Tommy asks.
Typically speaking, no. The best thing we can do, we do have a quote unquote limited recourse option kind of for your 1031 exchanges. We include a bad boy clause in there. So essentially, it is it's as non-recourse as we can make it. But there is a bad boy clause in there, essentially meaning if anything was lied on the loan application or any information is falsified in the loan closes, there is a back out clause there and the ability to recourse. That's typically done at reduced leverages. But we do have options for a 401k. I would say, typically speaking, though, most of our loans are going to be that full recourse option.
Yeah, and actually, if you go to our website, we have a non-recourse. There's only 2 lenders that we work with. So if you have a retirement plan, we have a couple of lenders on. North American Savings is one of them. You can go on there, and they can talk to you about financing within your retirement account. So we have that on there. Our website. Karen asked, do you lend on single family homes or just multifamily? We answered that, but yes, you can do both, single family and multifamily. Tommy asked, we can do new construction to perm loans for new construction. Yes, you do that, correct?
Yeah, so what we do for new construction loans is we actually kind of write it as 2 different loans, but we do pre-vet it on the front end. So I write a short-term loan, and this is actually how our fix and flip product or fix and hold works as well. We'll write a loan to finance all of your construction/rehab on the short end, and then once that loan is completed, we can then refi it into a long term. But it is technically a 2 transaction.
Okay, perfect. I have a general question, which there's a few questions on this, but closing costs. So obviously, closing costs are going to be. You can't give us a number, but what did you say you guys charge for your lender fee?
Absolutely. In fact, like I can give you the number most of the time on all of our products. So in any circumstance for any individual asset, whether it's a 5+ or not, you're going to be talking about $1,214 is our general closing fee. Now, other costs you're going to have to think about in addition to that, which are kind of just consistent across lenders: taxes and insurance, escrow. We include those as escrow payments monthly in the loan. You're going to have short interest, or essentially prorated rents on the loan, depending on what time in the month you would have closed. Obviously, you're going to have to think about title fees. We don't have an in-house title, but we can work with any title office you would like to work with. They will obviously charge those fees, and then points on the loan. So that's going to vary based on kind of what you selected. So that can be 0, that could be 2, that can be 3, and that's all based on loan amount in that situation.
Okay, perfect. Matthew asks, how do you underwrite? Do you have appraisals, loan to value ratios?
Yeah, absolutely. So yeah, we do our underwriting in-house. We will order a valuation option on each property. Depending on the product, we have a lot of flexibility for valuation options. Obviously, with the 30-year, there's a little bit less flexibility because we're writing a 30-year note loan. So we can't really work with, let's say, a BPO for something like that. We can work with either a full appraisal, which we will order through a third-party AMC, or a hybrid appraisal. As long as the loan is less than $750,000, I can do a hybrid, which is essentially a third-party inspection company will go to the property and take pictures, and then they'll send that report to the appraiser who does a desktop from there. It's a little bit cheaper than your standard appraisals. They charge a flat rate of about $400 on those, as opposed to your market rate for a full appraisal. If you are dealing with, let's say, a stabilized bridge purchase, let's say you just have a property that you can buy and you think you could resell, you think you're getting a discount, I can write that on a short-term loan with no prepay on it. For those, I can, if someone's experienced, I can do a BPO option, which is only $165 and we can get it back in about 3 to 5 days. Or we actually also have a no valuation or in-house valuation option for your fix and flip loans, where we can actually have the borrowers present to us their comps and rehab budget. And as long as they have the experience in that market to verify, we can go with that option as well.
Perfect. Okay. Next question. Emily asks, do you do rate locks for new construction?
For new construction, typically speaking, our short-term loans do have a essence of rate lock to them. Once they've had the appraisal order to them, we're typically going to stick to that. However, our rates are, I would say, the general company policy is the rates are up to kind of floating until we have that evaluation option come back. Once it comes back and the loan's underwritten, that rate's going to be good for 30 days plus. And at that point, we will close within that timeline.
All right. Let's see here. A few more questions. All right. So we got Carl. Says he has strong W-2 income, but little cash in hand. I have a HELOC with $250,000. Could that be used as a down payment on a loan?
It can be. That's definitely something our underwriting department looks into. Obviously, just we're making sure to write responsible loans. So we want to make sure that because we're not looking at income, and we can't do that because the type of loan we do, I can't leverage income for our loan. It is going to be based on that liquidity. Now, if someone had that liquidity or line of credit available to them, I can count that, but our underwriting team is going to look into how much is this borrower leveraged on their current accounts versus how much are they going to leverage doing this. Because if I'm writing a loan and I can only write it because someone has a certain amount of liquidity available and it cash flows, it's irresponsible of us to look at that and like, well, the only reason they have that is because they leveraged something else that we didn't think they were. So it is an option, but it is just going to be a kind of a common sense approach of, are we putting out and writing a safe loan for your borrowers, and are you not over leveraging yourself to put it in a dangerous situation? As long as that's the case, then we're not going to be in a bad place. Additionally, especially with these cash out sort of situations or even rate terms, a lot of this liquidity we're verifying is all just kind of like that, what we call our debt service check or rainy day funds check. It's not really money you're going to be paying at closing. And so there's a lot more flexibility with what we can verify. I can use 401k accounts for verification of liquidity. We do a discounted rate to it, so it's about 50 cents on the dollar. And really, I always stress safety with that, simply because that's not really available liquidity to most people. There is a lot of implications if you had to access that. But again, there's a lot of open optionality to what we can use to verify liquidity. Investment accounts, stock accounts, bank accounts, 401ks, all these things can be used to verify liquidity for us.
Okay, yeah, that's great. That's good to know that. Daniel asked, do you offer HELOCs?
We do not.
Yeah.
All of our loans are going to be first lien loans. We're going to pay off any existing liens on it, so we don't do anything really with second liens.
Yeah, most people don't do HELOCs on investment properties, unfortunately. It's just every once in a while I hear somebody that can do it, but there's not many banks I know, or very few that can offer.
Knowing a few lenders in the space, it is a niche product, to say the least.
Yeah. Hey, everyone was a few people asking if you could if you can go back a slide with your contact information on there while we have answer a couple more questions here. And again, you can go on our website, realwealth.com, log in and go into the resources tab, and you'll see Andrew's information there. I think it was, there we go. There's Andrew's phone number. So, okay. So Gary asked, do I have to escrow taxes and insurance? That's a great question.
We do require that be done in the loan. So those 30-year loans, we do require taxes and insurance be escrowed in the loan. What we're going to do is we're going to collect essentially, let's say you close the loan in June and the tax bill is due in January. We're going to basically collect what would have been 6 months on that, plus a 2-month buffer at closing.
All right. Okay. A couple more questions here. Karen says, what's the 10-year ARM now? I'm not sure. She's probably asking what the interest rate was. Do you know off
Yeah,
the
that's a
top of
great
your head?
question. So right now, I'd say like the really big advantageous one that can cut your interest rates about 0.2, maybe a quarter percent in some circumstances is the 5/1 ARM. The reason for that is for our types of loans, 95 or I believe 96% of them are refinanced within 10 years. So the advantage of writing a 10/1 ARM versus a 30-year fixed is rather nominal in that the loan is likely going to be refinanced before then anyways. So a discount rate isn't going to be as advantageous. Now, as rates can likely continue to rise with the Fed trying to tackle inflation, we are going to see more advantageous pricing for your ARM options. But really a 10/1 ARM, the most time I see that is for, honestly, for multifamily 5+ properties when the units are so large that I don't offer the fixed rate option, and that's the longest fixed rate that they can get. I typically don't see a lot of 10/1 ARMs. More I see 5/1 to 7/1 just because the advantage is rather nominal, but there is about like a point, I think it's about 0.01% difference in rate. So it could save you a few bucks here or there, but not too much as of right now.
Yeah. And so I'm sorry, did you say that what the rate was? Is it like 6.75? I mean, obviously it depends on how much you're putting
Yeah, so
down and
that's
everything, but
what
like,
I always like to say is I like to give a range simply because
yeah.
you as you can see, there's so much optionality to the programs. I have about 100 different rates that I could have on even just one property because I've got 20 different options at one setting, and then I've got about 5 settings after that to mix and match. Typically, right now, I would say a safe rate to get on most of our properties, and obviously this is going to vary a lot on type of property, cash flow on the property, someone's credit score. Someone with an 800 is going to get a heck of a lot lower rate than someone with a 700 credit. So we do take that into account. Typically around low 6s to low 7%, depending on buy down option, is typically what you're seeing right now. That will vary based on the size of the loan and those other factors that I talked about. The nice thing is I can get you pricing same day on all of these things. We have a very simple intake process of, hey, can you let me know the property address, what it's renting, what your credit score is, and what are those cash flow numbers. If that is sent to us, we will get you a preliminary quote within 24 hours or less for that. So, and we'll give you all those options that I showed before every single time. And I can write multiple quotes. It's not a problem. The only thing I would ask for my sanity is that you don't ask for every single option, just because it's going to take me a little bit longer to get you the quote back, and typically why we like to schedule those calls to make sure that we're presenting the options that make sense and not just throwing a bunch of information at you and having that overload the situation.
Yeah, that's great. That's great. Okay, well, that's all the questions we have for today. So I appreciate everyone. If you could go to the last slide, Andrew, I think the last one just says, thank you for coming. But yeah, I really appreciate everyone coming on. I'm sorry if we didn't get to some of your questions, but Andrew, you have his contact information. You can go to his website or our website and get his information too. You can always contact your investment counselor, me, Joe, or Leah. We're here to help you out too. But yeah, this has been great. And the timing couldn't be any better for this type of product. And we really haven't been talking about this product, but now I think the timing is fantastic because given the circumstances. So, so Andrew, I appreciate your time again. Thanks so much. And look forward to speaking with our members, and have a great day. I appreciate your time again.
Absolutely. Have a great day, everybody.
Yeah, bye-bye. Thanks.